I don't talk about it often on this channel, but I actually went to university for all of this financial mumbo jumbo. I have a master's in financial analysis and investment management, and a lot of the things that I learned in that studies is pretty much useless. The more you study the theory, the more you understand how much it is completely irrelevant and detached from reality. For example, how should we value an investment? The super basic stuff. The basic principle is that the fair value of an investment is equal to the sum of the future cash flows discounted to the present future. What does this mean? It means that if we look at a cash flow, say in 30 years, that cash flow should be worth less to us today compared to a cash flow that comes tomorrow. So we have to discount future cash flows. We have to sum up what kind of money can we expect in the future. And the further it's out in the future, the less it's worth to us. And also the more we have to discount that future cash flow, the less it's worth to us as well. So that is the basic fundamental idea. We've got, say, $1,000 cash flows for the next 30 years. And that could be an apartment. That could be a very stable stock that does not increase its dividends. It could also be a bond. A bond is probably the best example because over there we've got 100% guaranteed. Let's say it's a US bond that we will get that money. And we also know what kind of money we can expect, right? We've got the fixed coupon payments. And so the sum is not just, say, $30,000. The sum of the cash flows is less, as in the present value of that bond is less because we have to discount. And we do this by more and more every year. So the first cash flow 1 year from now has to be discounted by 6.8%. The second one by 1.068 to the power of 2 and to the power of 3 to the power of 4, etc. You get the idea, right? This is the idea of discounting future cash flow. Sounds all logical, right? And that then also explains various things. That explains, for example, why people say when interest rates go down, then in theory, asset prices across the board should go up, right? Houses should go up because, of course, also mortgages get cheaper, but even stocks should go up because the discounting is less. Bonds should go up, all of that, right? There is an inverse correlation between interest rates and prices. Interest rates go down, prices go up, and vice versa. Interest rates go up, prices should go down. And so let's test this theory, right? Because everybody talks about this also in crypto, right? In crypto, everybody says if there's only monetary expansion, if only the Fed balance sheet is going to go up, if only interest rates are coming further down, then all the risk on assets will go up in price, especially Bitcoin and the altcoins, etc. But let's start off with the super basics, right? When we know the future cash flows, as with a coupon, right? When we know the future cash flows with a
To get the full length video, feel free to simply subscribe over here. Then you get it recommended by the algorithm.